Let me tell you about the most expensive mistake in crypto. It's not buying the wrong coin, it's not missing the bottom, it's not even panic selling during a crash. It's building real wealth, finally doing everything right, and then handing 37 cents of every dollar straight back to the government the moment you try to spend it. This is the part of the Bitcoin story nobody talks about. Not the YouTubers pumping portfolios, not the Twitter influencers flexing screenshots. Nobody wants to talk about taxes because taxes aren't sexy. But I'll tell you what's even less sexy. Working 5 disciplined years to build a 6-figure Bitcoin position and then losing 30,000, 40,000, maybe more of it to a tax bill you never saw coming because nobody ever walked you through the exit. In the last 2 videos, we dismantled the meme coin illusion and handed you the exact DCA blueprint to build $100,000 in Bitcoin over 5 years. If you haven't watched those, there's a link in the description. Go watch them first, then come back. But Today, we are talking about the part of the wealth building equation that separates the people who accumulate money from the people who actually keep it. We are talking about the tax-optimized Bitcoin exit strategy. And I want to be crystal clear about something before we dive in. I am not a licensed tax attorney or a CPA. Nothing in this video is personalized tax advice. What this video is a financial education framework. The specific application to your situation requires a qualified tax professional. But here's the thing, most people never even get to the conversation with a professional because they don't understand the landscape well enough to ask the right questions. That's what today fixes. By the end of this video, you will understand exactly how Bitcoin is taxed, the 5 legal strategies wealthy investors use to minimize that tax burden, and the precise moment in your wealth journey when each strategy applies. Let's go. First, and this is foundational, you need to understand how the IRS actually classifies Bitcoin because most people assume it works like cash. It doesn't. The IRS classifies Bitcoin as property, not currency, not a stock. Property, like real estate, like art, like a business asset. Why does that matter? Because every single time you sell, trade, spend, or exchange Bitcoin, every single time you trigger what's called a taxable event. This shocks most people. You swap Bitcoin for Ethereum, a move you might not even think of as selling, and the IRS considers it a fully reportable disposal of property. You owe tax on the gain. Now let's talk about which tax you owe, because this is where the real money lives and where most people completely destroy themselves. There are 2 types of capital gains tax on Bitcoin. Short-term capital gains. This applies to any Bitcoin you've held for 1 year or less before selling. The tax rate? It's taxed as ordinary income. That means whatever tax bracket you're in, 22%, 24%, 32%, 35%, 37%. That's the rate you pay on every dollar of profit. Long-term capital gains. This applies to Bitcoin held for more than 1 year before selling. The tax rate drops significantly. For most middle-class earners, the long-term rate is either 0%, 15%, or 20%. Let me show you what this gap actually costs in real dollars. Say you bought $20,000 of Bitcoin. It's now worth $80,000. You have a $60,000 gain. If you sell after holding less than 1 year and you're in the 32% bracket, you pay $19,200 in federal tax on that gain. If you wait until you've held it for more than 1 year and your long-term rate is 15%, you pay $9,000. Same Bitcoin, same profit. $10,200 difference just for waiting 12 months. That is not a small number. That is a family vacation. That is 6 months of DCA contributions. That is real money, and it costs you nothing except patience. One more concept before we get into the actual strategies, and this one is critical. Cost basis. Your cost basis is simply what you paid for your Bitcoin, your original purchase price. Your taxable gain is calculated as sale price minus cost basis. Here's where DCA investors need to pay close attention. Because you've been buying Bitcoin in small amounts over months or years, you have dozens, maybe hundreds of individual purchase lots, each one with its own cost basis and its own purchase date. When you sell, the IRS requires you to account for which Bitcoin you're selling, and the method you choose for that accounting can mean thousands of dollars in tax difference. We are going to come back to this because choosing the right accounting method is strategy number 3, and it's one of the most powerful tools you have. First, let's build the complete 5-strategy framework. The wealthy don't panic when it's time to take gains. They have a playbook, 5 strategies used in combination that legally and dramatically reduce their tax bill. Here they are. Strategy number 1, the holding rule. 12 months is the magic number. We already established this mathematically, but I want to make it behavioral because knowing it and doing it are 2 different things. The single most powerful tax optimization available to a DCA investor costs exactly $0 and requires exactly 1 action. Don't sell before 12 months. That's it. Hold every purchase lot for a minimum of 366 days before selling, and you cut your federal tax rate on that gain potentially in half. Now, the challenge, and this is where it gets psychologically hard, is when Bitcoin is exploding upward, and you bought some 3 months ago at a fantastic entry. All instinct tells you to take the profit now. The gain is sitting there, it feels urgent, but run the actual math before you make that move. Calculate the exact tax cost of selling now at short-term rates versus waiting the remaining months for long-term treatment. In most cases, the tax savings of waiting will comfortably exceed any price risk of holding 3 more months. Strategy number 2, tax loss harvesting. Turn your losers into weapons. Here's one of the most underused strategies in crypto, and it's especially powerful for DCA investors who also hold other assets. Tax loss harvesting means deliberately selling a position that is down to realize a capital loss and then using that loss to offset capital gains elsewhere in your portfolio. Let me give you the concrete version. You've got $30,000 in Bitcoin gains you need to realize this tax year. You also hold an altcoin, maybe something you bought before you watched this series, that's currently sitting at a $15,000 loss. If you sell both in the same tax year, your net taxable gain drops to $15,000. You've cut your tax bill in half, legally. Instantly. And here's the beautiful part for most of the people watching this series. Remember all that meme coin garbage from part 1? The dog coins sitting in your portfolio at a 70% loss. Those losses aren't just a mistake anymore. They're a tax asset. Realizing those losses strategically can offset real gains from your Bitcoin DCA, effectively letting the government share in your past mistakes while you keep more of your current wins. Critical note, the IRS has a wash sale rule for stocks. You cannot sell an asset at a loss and repurchase the same asset within 30 days. As of current IRS guidance, crypto is not yet subject to the wash sale rule. This means you can sell a losing crypto position, harvest the loss, and immediately repurchase if you want to maintain exposure. However, this is an area of active legislative attention. Consult a tax professional to confirm current rules before executing this strategy. Strategy number 3, specific identification. Choose which Bitcoin you're selling. Remember when I mentioned that DCA investors have dozens of individual purchase lots, each with its own cost basis and its own purchase date? When you sell, the IRS requires you to specify exactly which purchase lot you're selling, not just a first-in, first-out average. This is called specific identification, or SID. Here's why it matters in practice. You need to sell zero point 0.1 Bitcoin today. Which lot do you choose? The instinct is to sell lot A. It has the biggest gains, so you feel like you're taking profits from your best trade. But if you're trying to minimize taxes right now, the optimal choice is lot C, smallest gain, and it would be taxed at short-term rates anyway, so the tax damage is minimized. Or better yet, lot B, it's long-term, so even though the gain is larger than lot C, it will be taxed at a much lower rate. Without specific identification, most exchanges default to FIFO, first in, first out. That means they automatically sell your oldest Bitcoin first, which is almost always your lowest cost basis, generating your largest possible gain. The IRS isn't forcing that on you. The exchange default is doing it. You can change it. This single setting change, selecting the right lot when you sell, can save thousands of dollars per transaction on a mature DCA portfolio. Strategy number 4, the income timing strategy. Sell in your lowest income year. This one sounds obvious once you hear it, but almost nobody executes it deliberately. Your long-term capital gains tax rate is determined by your total taxable income in the year you sell, which means your tax rate on Bitcoin gains is not fixed. It fluctuates based on when you choose to realize those gains. The long-term capital gains brackets in 2024 are 0% for income up to $47,025 single, $94,050 married, 15% for income up to $518,900 single, 20% above that. For many people, there are specific life windows where income temporarily drops: the year between jobs, early retirement, a sabbatical year, a year you maxed out pre-tax retirement contributions, a year you had significant business losses. These windows are golden for Bitcoin exits. If you can structure a partial Bitcoin sale in a year where your total income, including the gains from the sale, stays below the 15% threshold or even below the 0% threshold, you are literally paying nothing in federal capital gains tax on that portion of your Bitcoin wealth. 0%. Legal, available to regular people, almost completely ignored by the middle class because no one ever explained it. Strategy 5, the borrow, don't sell strategy. How the wealthy spend without triggering taxes. This is the strategy that genuinely separates the wealthy from everyone else. And it sounds almost absurd when you first hear it. The wealthiest Bitcoin holders don't sell. They borrow against their Bitcoin to access cash. Here's how it works. You have significant Bitcoin holdings, let's say $200,000 worth. You need $50,000 to fund a business, renovate a property, or cover a major life expense. Instead of selling $50,000 of Bitcoin, which triggers a taxable event, you use your Bitcoin as collateral for a low-interest loan. Several regulated, established platforms offer crypto-backed lending. You receive $50,000 in cash. You spend it. You pay back the loan over time. The loan interest is a real cost, absolutely, but when your Bitcoin is appreciating at 30% annually and the loan interest rate is 8 to 12%, the math often still favors borrowing over selling. You keep the position growing while accessing the liquidity you need, and you defer the tax event indefinitely. This is not exotic. This is exactly how wealthy real estate investors have accessed liquidity for decades, refinancing properties instead of selling them, accessing equity without triggering tax. Bitcoin is finally enabling the middle class to use the same mechanism. One critical risk disclosure: crypto-backed loans are collateralized. If Bitcoin's price drops significantly and your loan-to-value ratio breaches the lender's threshold, you could face a margin call, meaning you either add collateral or a portion of your Bitcoin is liquidated. Never borrow more than 25 to 30% of your Bitcoin's value. This is a strategy for mature, substantial Bitcoin positions, not for someone just starting out. Here's how to think about these 5 strategies across your actual wealth-building timeline. Years 1 to 2, pure accumulation phase. You're DCAing, you're building, you're not exiting anything except meme coin garbage. This is the time to harvest any existing crypto losses, establish your exchange's specific identification accounting method, and start keeping meticulous records of every purchase, timestamp, amount, price paid, exchange, every single transaction. Years 2 to 4, growth phase. Your portfolio is building real size. You're approaching and crossing the 50K mark. The holding rule is your primary weapon. Hold every lot to long-term status. Begin working with a crypto-specialized CPA if you haven't already. This is not an option at this stage. Year 4 to 5, strategic partial exit phase. As you approach your target, $100,000 or beyond, you begin planning your partial exits using income timing. Identify your lowest income windows. Use specific identification to choose your highest cost basis lots first. Layer in tax loss harvesting from any remaining losing positions to offset gains. Year 5 plus, mature portfolio phase. At significant portfolio size, the borrow don't sell strategy comes online. You're accessing liquidity through collateralized loans while your Bitcoin continues to compound. You sell only what you must, only in low-income years, always using specific identification. Let's close with the exact action steps. No fluff. Action 1, start tracking every transaction today. If you have Bitcoin on an exchange, export your complete transaction history right now and save it somewhere permanent. Every purchase, every sale, every transfer. The IRS expects records. Crypto tax software, there are several reputable options in the description, can automate most of this once you connect your exchange accounts. Action 2, change your accounting method to specific identification. Log in to your exchange settings, find the cost basis accounting method, change it from FIFO to specific identification. Do this before your next sale. Some exchanges allow this mid-portfolio. Your crypto tax software can handle it even if your exchange doesn't. Action 3, hire a crypto-specialized CPA before you have a big exit. Not a generalist accountant, not TurboTax, a CPA who specifically works with crypto clients and understands IRS Notice 2014-21, the current wash sale debate, and crypto-specific deductions. The fee pays for itself in the first tax-optimized transaction. This is not an expense, it is an investment with a guaranteed positive return. Action 4, plan your income calendar around your exits. Have an honest conversation with yourself and your CPA about which years over your 5-year plan represent your lowest income windows. Map your planned Bitcoin exits to those windows deliberately. This is not reactive tax filing. This is proactive wealth architecture. Action 5, never sell in panic, never sell in excitement. This is the behavioral rule that ties everything together. The worst tax outcomes don't come from bad strategy. They come from emotional decisions, panic selling during a crash, realizing short-term losses when you should be buying more, impulse selling during a euphoric rally, realizing short-term gains at the highest possible tax rate because the excitement overrode the math. Your exit plan should be written before the market gets exciting or terrifying. Write it down now, when you're calm, rational, and working from the numbers. Then follow it when the market tries to make you emotional. Here's the full truth of this 3-part series. Building wealth with Bitcoin is not complicated. It is simple. Buy a scarce, hard asset. Buy it consistently. Hold it through the noise. That's part 1 and part 2. But keeping that wealth, that is where most people fail. Not because the strategies are secret, because they never took the time to learn them. You just did. The IRS is not your enemy, but they are not your financial advisor either. They will take exactly what you allow them to take. Your job, with the right professionals and the right strategies, is to legally, ethically, and intelligently minimize that number. Every dollar you keep is a dollar that compounds. Every dollar that compounds is a dollar that buys you freedom. Subscribe, because part 4 is coming, and we're going to talk about the estate planning layer, how to pass your Bitcoin to the next generation without the government taking another enormous cut on the transfer. Because the whole point of building generational wealth is that it actually reaches the next generation. Drop a comment. Which of these 5 strategies are you going to implement first? I read every single one.
Stay disciplined, stay informed, keep more of what you build. I'll see you in the next one.